Selling an investment at a loss is almost never a choice. It's a necessity. And when the world's second largest economy decides to unload billions in US Treasury bonds, quietly absorbing the hit, global financial markets go on high alert. For decades, China was America's biggest creditor. It was a relationship of mutual dependence that kept the global system standing. But that relationship has just hit its lowest point since the 2008 financial crisis. In a single month, nearly $240 billion left U.S. Treasury bonds, a coordinated move that includes Japan, but with Beijing at the center of gravity. The common explanation points to trade war tensions and pressure on Asian currencies. But that's only the surface. The real cause is buried inside Beijing, a mountain of internal debt that the Chinese government is desperately trying to keep from collapsing, and that almost no one is connecting to this capital flight. The model that built China's economic miracle is seizing up, and the country is now being forced to burn its external reserves to avoid a collapse at home. In that scenario, holding $652 billion in US Treasuries isn't prudence. It's a luxury China can no longer afford. So what is really happening inside China's coffers? And why could this be the clearest signal yet that the era of the dollar as the world's reserve currency is coming to an end? I'm going to show you how this board is set up. Because what the numbers are hiding is far more disturbing than any conventional analysis is willing to admit. Markets were under pressure from the US-Iran conflict, oil prices surging, currencies squeezed, energy bills rising across Asia. And it was in that environment that China made a move the market wasn't expecting at this scale. Beijing quietly exited a massive position. Nearly half of everything they held in US Treasuries simply vanished. The official numbers confirm it. From a peak of $1.3 trillion, their holdings dropped to just over $650 billion, the lowest level since September 2008, and part of that exit happened at the worst possible moment, with bond prices falling, locking in $142.1 billion in valuation losses in a single month. When the Middle East conflict put pressure on the Chinese currency, the response was to sell dollars to defend the exchange rate. That's not an ideological choice, it's an operational necessity. But here's what that sell-off actually reveals. China didn't have enough cushion to absorb this moment without cost. The buffer was thinner than it looked. And the question why China sold US debt right now has an answer that goes far beyond the war. But here's where things get strange. If you're only looking at the war, you're missing the most dangerous move. Beijing started making 2 years before any bomb fell. And the reason wasn't financial. It was a reality check that changed everything. Since 2022, Chinese banks have been quietly cutting their international dollar-denominated lending. The reduction has reached nearly 10% in 2 years. The yuan's share of Chinese banks' overseas lending has more than doubled since 2021, reaching nearly 40%. When a Chinese bank lends money to a trading partner today, there's almost a 40% chance that loan is in yuan, not dollars. This isn't a market fluctuation. It's an architectural shift in global finance. But why 2022 specifically? What changed that year that made China accelerate something it had been putting off for decades? Two factors converged. The first was about cost. US and European interest rates rose sharply, making dollar and euro lending more expensive. The yuan suddenly became one of the cheapest funding currencies available to Chinese banks. Lending in yuan simply made more financial sense. The second factor no one likes to say out loud. The West froze Russia's reserves after the invasion of Ukraine. That was a shock to Beijing. If the US and Europe could block hundreds of billions of Russian dollars overnight, they can do the same to China. Holding $1.3 trillion in US Treasuries stopped being a symbol of strength and became a potential vulnerability. The exit started there. The war only accelerated what was already in motion. All right, China is leaving the dollar by strategy. But what no one tells you is that it isn't doing this transparently. There's a parallel market of hundreds of billions that official numbers are trying to hide at all costs. And here's exactly where that money is hidden. Even with all this selling, the real picture of China's dollar exposure is more complicated than the headlines suggest. It's like someone who officially declares owning one car, but has five more parked in the neighbor's garage. On paper, the fleet looks smaller. In practice, it isn't. Analysts have long suspected that China uses countries like Belgium and Luxembourg as intermediaries to hold US Treasuries, what's known as shadow holdings. The logic is straightforward. If you want to reduce your dollar exposure without triggering market panic, you don't announce it. You redirect positions through sovereign wealth funds and state-linked entities in custodial jurisdictions. The data shows Belgium held $454 billion in US Treasuries, essentially flat during the period. Luxembourg also held steady. China's direct reduction is real. But total dollar exposure, counting the intermediaries, is larger than the official numbers show. That doesn't cancel the trend, but it explains why the answer to why China just sold hundreds of billions in US debt at a loss is more strategic and more gradual than any single headline can capture. Now, forget the dollar for a second. There's a timer running inside China itself that is far more urgent than any fight with the United States. It's a mountain of debt growing in the dark, and it explains why China was willing to take a loss selling its treasuries right now. What the IMF knows and what isn't making any headlines. If you don't understand this number, you don't understand anything about the future of Asia. And now we get to the point that almost never shows up in analyses about why China sold US debt, and that completely changes the interpretation of everything. China's own debt. The IMF released its most recent assessment of the Chinese economy in February 2026, data that just came out and that markets haven't fully priced in yet. GDP growth was 5% in 2025, a number any developed country would envy. But underneath that number, the picture is different. Private domestic demand ran out of steam. Average inflation was 0% in 2025. And the GDP deflator, the broadest measure of price pressure in the economy, continued to decline. Deflation with high debt is the worst possible scenario. The debt stays at the same nominal value, but revenue weakens in real terms. The bill gets more expensive every year even without borrowing a single additional cent. And here is the China debt that almost never makes the headlines. China's augmented debt, including local government financing vehicles, the so-called LGFVs, structures created by provinces to fund infrastructure off the official balance sheet, reached 126.6% of GDP in 2025. To put that in perspective, it's a household earning $100,000 a year carrying $126,000 in debt, not on a credit card, but in structures the head of the household doesn't officially acknowledge as theirs. The IMF, however, knows exactly who's paying in the end. And this backpack isn't just heavy, it's gaining new bricks every year. The IMF projects this debt, which is already larger than everything China produces in a full year, will keep growing until it reaches levels that block any attempt to respond. It's a weight that doesn't disappear with growth, doesn't disappear with record exports, and it explains why Beijing is willing to take a loss selling US Treasuries right now. China's internal debt and the reduction in US Treasuries look like separate issues. They're not. They're two sides of the same problem. When China needs liquidity to intervene in currency markets, bail out the real estate sector, or prop up local government debt vehicles, it needs resources. Historically, part of those resources was stored in US Treasuries. Selling at a loss in a moment of pressure isn't an elegant strategy. It's what happens when internal pressure is large enough to justify the external cost. The reduction in dollar lending by Chinese banks isn't separate from the China debt problem either. The yuan became cheaper to lend precisely because the central bank kept rates low to try to stimulate an economy that keeps resisting recovery. Low rates, deflation, weak domestic demand, these are symptoms of an economy that hasn't yet found the growth engine to replace real estate. The IMF was direct. Stabilizing China debt over the long term will require significant fiscal consolidation, but that can only begin once deflation is reversed. While prices are falling, tightening the budget would make demand weakness worse. It's a circular trap. Every attempt to fix one problem puts pressure on the other, and there's no quick way out. That looks like a dead end, right? It is. But the most frustrating part is that China has the money to fix this. So why isn't it fixing it? Why let the country drift toward this edge? The answer reveals Beijing's biggest fear today. Here's what makes this case genuinely complex. China has the capacity to deal with these problems and still can't find a simple way out. International reserves reached $3.7 trillion in 2025. The current account surplus was 3.3% of GDP. In terms of raw capacity, very few countries in the world have this kind of room to maneuver. The problem isn't capacity, it's structure. An economy that needs to shift growth from infrastructure and real estate investment to domestic consumption in a society with high savings rates, consumer confidence shaken by the property sector, and a rapidly aging population doesn't make that transition in a quarter. The IMF recommended consumption-focused fiscal stimulus and central government support for the real estate adjustment. The diagnosis is right. Execution is the challenge. And while execution stalls, China debt keeps growing and dollar exposure keeps shrinking, not because Beijing decided to abandon the system, but because it's managing an internal crisis with the resources it has. So why did China sell billions in US debt at a loss? The immediate answer: the Middle East conflict created currency pressure and Beijing had to act. The sell-off was an operational necessity, not an announced strategy. The structural answer: because since 2022, China has been building a financial architecture alternative to the dollar, accelerated by the fear of ending up in the same situation as Russia. The answer to why China sold US debt runs through a long-term strategy that the war only made more urgent. And the deepest answer, the one almost no one is connecting to this sell-off, is China debt. 126.6% of GDP in augmented debt, persistent deflation, real estate in adjustment, domestic demand without traction. In that environment, holding hundreds of billions of dollars in another government's bonds while your own house needs the resources is a luxury that's becoming impossible to sustain. The dollar is still the world's dominant reserve asset. Nothing in this video suggests otherwise. But what the data shows is that China is exiting the dollar from the edges not head-on, not with announcements, but with concrete actions that compound every month. And when the world's second largest economy moves like that, it's worth paying close attention to what's hiding behind the numbers. If this video made sense to you, subscribe to the channel. There's a lot more analysis like this coming. And drop a comment. Do you think China can solve the China debt problem without a major crisis? Thanks for watching.